Black Stars Investment 101. I have here with me Michael Amek, who is with our global markets team, and then Mr. Immanuel Shen, who is also with our asset management team. We've been discussing fundamentals in investments. We've spoken about some terminologies. At this point, we are going to delve directly into trading activities and what needs to be considered. So fasten your seatbelts for this round. I want to begin with Michael. Michael, so if I buy shares in a company today, what exactly am I buying? Is it a piece of profit or just ownership and voting rights?
Companies don't always pay dividend. It basically depends on what the company's outlook is, what their projections are, what they think is going to help the company. Because in investing, the best thing that they are looking to do is to bring value to the shareholders. So if paying out dividends is going to cause pain to the company's pockets, then they are not going to do that. Now, companies that usually pay dividends are companies that most likely reach maturity. That is, they have been in the game for quite some time and they don't need all the profit they have made to run their business. So they have been able to take care of all operating costs associated, paid all taxes, all liabilities, and there is still some residual profit left, and then they can decide to share with the shareholders.
Right. So, as a shareholder, how does the company benefit from me?
Yeah, so the company benefits from you primarily when there is going to be the IPO, right? So once the company is going to list, the money that all individuals give, or that is the institutions as well give, is referred to as patient capital. Because when you invest in a company, you are not asking them to pay you interest or coupons on a monthly basis. You've told them that take my money, go and work with it, and when the company becomes profitable, you are able to pay me dividends. So it is when the individuals or the firms have given their money or have given their trust to the company that they have gathered the money, have given to the company to be able to use. And then once the company starts making profits, they would be able to get some.
Yeah, just so that Carl did the right issue.
Yes.
To raise more capital.
Yes.
So there are instances where the company would say that I need more capital. So
Yes.
account to the market. If you have 1,000 shares, I can give you, if the price of the share is 1 and you have 1,000 shares, for each share that you have, you can buy 2 extra shares for each share.
Yeah.
But instead of paying 1 CD, pay 80 pesos.
Mm.
Right. So you are essentially giving them new capital and you are increasing your number of shares held.
Yeah.
So there are instances where that happens as well. But what that gives the company, as Amek said, is that it gives them patient capital. So in this sense, you're not looking at the next 6 months how to pay something back to my investors.
Yeah.
Right. But you can retain all that money and then use it to grow the company. You mentioned something about on the dividend side. You find that companies that are in their early stages, so like you find a lot of the tech companies, they won't pay dividend because all monies are channeled back. It means that they have a view that there are more businesses that they can do. So they use all that money to grow.
Reinvest.
Yeah, they reinvest that money and grow the business more. But for companies that are more mature, maybe they are at the point where everything is paid off and they don't see any future huge drawdowns or capital spend, and so they can commit some amount of money as dividend to their investors.
Okay. So dividend payments will also be determined by the growth cycle of the company.
Yes.
There are instances where a company would pay dividend because they made profits, and instances where they will have to claw back the profit by investing
Into a business.
So what if they make a loss in a particular year? What happens to me as a shareholder?
Well, nothing happens to you as a shareholder. That is why they organize annual general meetings, right? and you have the right, because you're a part owner of the company, to voice whatever whether frustrations or whether you think that they should go in a certain direction, right? So it basically gives you room to be able to have a conversation with the company, because there are even situations where it is not the company's fault they have made a loss. There are economic factors that may have contributed to what has happened to the company's revenue. So yeah, you just have to have that discussion with them, and that is why, like I said, they open forums for investors to come and then have a sit down with them and have the conversation.
Okay. In the initial part of the conversation, you mentioned that the shareholder in dividends or in capital gains. I think this would be a good time for you to tell us what capital gains are and how different it is from dividends.
Okay. So if you are investing on the stock market, there are two ways you can make money: through capital gain, like you have said, and through dividend payment. Now, this is what capital gain is, and I'm going to use practical numbers. When the company IPO'd, okay, or when the company initially offered their shares, the shares were going for, let's say, 1 cedi. Now it has been listed and has been trading, and then people's perspective or perception about the company is positive. So there's a lot.
Are there any taxes on dividends?
Yes, I think there's an 8% withholding tax on dividends paid here in the country.
Okay, all right, thank you very much. I would want to turn my attention to Emmanuel now, Eshen. So since you're a portfolio manager, I believe there are certain times that you would want to take certain securities out of your portfolio and bring others in, right? So how do you determine which stock to buy at any particular time? Or how do you determine the attractiveness of a particular company to invest in that?
Yeah, that's one of the questions that we've been having recently. And as I said earlier, when you're investing for a certain amount of future return, right? So it means that you're looking into the future to say that by the end of my investment period, maybe 5 years, I want to make this amount of